Thank you very much, Marty. Excited to be here. Hello, everyone. So following on Marty's words, we are a big advocate for what we do. Running Point is a multifamily office, like Marty described. We're also a PPLI manager, private placement life insurance manager. So we manage assets and finances for wealthy individuals, families, and business owners. We also provide private placement life insurance management, which is a phenomenal tax-free wealth building strategy. We provide that for other wealth managers, family offices, and estate professionals that want to offer that service to their clients. We can create bespoke portfolios for them. And it's especially relevant for a lot of private investments, because you figure you do a private investment, it is illiquid, you're going to be locked up in it. So not much harm in putting an illiquid investment inside a somewhat illiquid vehicle, but getting to compound tax-free. So your private credit strategies, your hedge fund strategies, the things that you really like but are tax inefficient, it's great to put them inside the structure. But enough about that. We can talk about that later. I want to signpost and provide a quick outline of today's topics. Then I'll go into detail, and hopefully we can follow up with some Q&A, if that's not a problem, because I usually enjoy Q&A. So I'm going to cover 2023 outlook, the debt ceiling mayhem that's already happening, commercial real estate, a little bit of a radar on recession, housing, or as I like to call it, game of homes, and opportunities in private investments. And like I said, hopefully we can follow up with some Q&A. So starting off with the 2023 outlook. Well, actually, in January of last year, I said that 2022 would be the terrible twos. And it was. It was a really bad year for most asset classes. In January of this year, I said 2023 would be a Tom and Jerry year. Kind of like the cartoon, Tom and Jerry, the cat and mouse. Everything goes in one direction until it reverses and it goes in the other direction. It goes in the cat's favor, then the mouse's favor. And I saw 2023 as a Tom and Jerry year from two perspectives. One, there would be a lot of back and forth in data and expectations regarding inflation numbers, payrolls, and economic outlooks. And I believe we are witnessing that in the economic data and the expectations, as well as in the banking crisis that we've seen. I mean, it's May 3rd now, and we've seen the 2nd, 3rd, and 4th largest US bank failures ever. Silicon Valley Bank, Signature Bank, First Republic. What does that do to the economy? It crimps credit, it crimps lending. And as you all know, our form of American capitalism really only works with credit. So any crimp on that, any fear from the banks, it has the potential to slow down the economy. The other Tom and Jerry factor is the cat and mouse game between the Fed, the Federal Reserve, and the Biden administration. How is that a cat and mouse game? The Fed is trying to slow the economy, to stem inflation, possibly trying to push us into recession. I think Powell, to a certain degree, is trying to follow Paul Volcker's book from the 80s, and maybe want some of that Paul Volcker fame in taming inflation. I think maybe Powell has moderated over the last year and might not be as adamant and stringent as Volcker was to push us into inflation. I mean, to push us into recession, but he definitely wants to tame inflation. And one of the lessons we learned from the 1980s was that inflation is very volatile. And Volcker's administration was whipsawed by inflation going up, down, in a volatile pattern. And I don't think Powell wants that to happen. And that's one of the lessons he learned. But anyway, the Fed is in a cat and mouse game with the administration because the Fed's trying to slow the economy while the administration is stimulating with the American Rescue Plan, the Inflation Reduction Act, major green tech spending, much of it, funny enough, going to the red states, climate initiatives, including 161 billion in new tax credits to create incentives for companies to provide clean energy, 80 billion to urge consumers to buy new and used vehicles, other incentives. So, Biden's in the third year of his administration. You kind of want to stimulate the economy in the third year. So when you go into the fourth year and you're up for re-election, the economy looks good. And that is somewhat at odds with the Fed that's trying to rein in the brakes on a strong economy. That leads me now to the debt ceiling mayhem that's happening. I think most of us probably remember a pretty terrific movie called Back to the Future. I wrote an article called Debt to the Future, kind of a play on words there and a play on the movie. The outlook, the theme here is that we are not yet out of time on the debt ceiling, but we're getting close. And originally that period was that sometime we might hit the brink, the X date, somewhere between June and September. But it's looking like we'll be earlier in that X date because a lot of states don't have to pay their taxes till October because of emergency measures that went through, like in California. So we are not yet out of time on the debt ceiling, but getting close. Polar divisions between Republicans and Democratic Party could push a compromise to the brink or beyond. Hopefully it doesn't go beyond. If the government doesn't pay off securities when they mature, I feel there may be few places to hide. A US government default could lead to financial crisis and ripple through the global economy. What can we do? There's really not much we can do, but I suggest consider adding contingency clauses to any large purchase or sale agreements that you may have that may close around the time of a potential US debt default. Why is that? If the US defaults on the debt, they'll still have some revenue in, they'll be able to make some payments, but it's unknown what payments they will make and which ones they'll skip out on. If they skip out on Social Security payments, you'll have millions and millions of retirees mad. So maybe they don't skip out on Social Security and Medicare, but then maybe they skip out on bond payments, on T-bills. And there's a lot of companies that keep their excess cash in T-bills. So, if you have some T-bills maturing and you think they're going to mature in time to pay for a home purchase or a capital expenditure purchase or a merger and acquisition, suddenly they mature. If the US government decides not to pay off the T-bills, you don't have the money for your purchase. So you say, hey, Michael, fine, I won't be in T-bills, I'll be in a money market. Well, the problem is money markets mostly invest in T-bills and other government securities. So you're like, okay, I won't do money market, I'll put my money in a bank. Well, we kind of know how safe banks can be, but even if the bank is safe, where do the banks keep their money? The banks keep a lot of their money in treasuries and T-bills. So if suddenly you have $10 million at the bank and you try to pull it out to make a purchase and the government's not redeeming T-bills, the bank may not be able to give you your cash. So the ripple effects of the US actually defaulting on its debt would be quite catastrophic. And I think we'd see that catastrophe within a matter of days. And there would be an imminent solution because there'd have to be an emergency solution. Either Congress and the administration would strike a deal very quickly, or if you've heard about the $1 trillion coin, according to law, the US Mint can mint a commemorative coin in any denomination that's been written into law, but never tested. So theoretically, the Mint could print a $1 billion single platinum coin, deposit it at the Federal Reserve Bank, and bingo, suddenly there's $1 trillion more. It hasn't been tested. They could do it and then see if anyone objects to it. That could be a solution. Either way, the rest of the world is looking at the US and wondering what's going on. We think of the US dollar as the #1 reserve currency in the world, and then maybe followed by the euro, and then the British pound, the Japanese yen, other currencies. Yes, maybe the US dollar is the #1 reserve currency, but honestly, the #1 reserve currency in the world is trust. It's trust and faith. It's trust and faith in that government maintaining the value of the currency. So yes, the US dollar is the #1 reserve currency, but truly it's trust and faith. And what we're doing by bringing the US government to the brink on the debt ceiling, it's eroding a lot of that trust and faith in the US. And that's being played up in the international press, in Europe, in Asia, in Africa. It's, we are a strong and terrific country, but it's a little bit of a chink in our armor, and it hurts. So like I said, hopefully we don't go past the brink. If we do, I think it will be resolved within a matter of days because there will be mayhem. We won't have access. If push comes to shove, we might not have access to cash. We may not be able to get it from the banks. It'd be quite disruptive. What are the chances of this happening? Someone asked me that a couple of weeks ago when I wrote this article. Honestly, I think it's a 1 in 16 chance. It's not huge, but a 1 in 16 chance is still a 7% chance. That's how I see this playing out. Moving on from the debt ceiling, let's look at commercial real estate. Marty brought up commercial real estate. It's interesting. Yeah, I think commercial real estate's in trouble. I think it will find a bottom. Some of it can be converted into apartments or housing, but if you have really, really huge blocks of real estate, the inside of those buildings, the center of those buildings get really dark and are not quite suitable for residential. They work well for an office, but residential buildings like windows and window spaces. Commercial real estate, office buildings are hard to convert into lab space because lab space is a very, very specific type of real estate. But it will find a bottom. We saw this with retail and malls have found a bottom. Commercial will find a bottom. Do I think this is going to be a major fallout for the economy? Not directly, but indirectly, there will be a butterfly effect combined with the bank failures. There'll be a crimping of lending, which could negatively affect money supply and economic growth. So that's just something for us to watch out for. As far as recession, I said it back in January, it's still my feeling, recession is not inevitable in 2023. I think there's a good chance that we don't have recession in 2023. I know there's a lot of people calling for recession. And look, it probably should have happened if not for all the stimulus we have from the pandemic and from the administration. And quite frankly, employment's good. Unemployment's extremely low. Hiring numbers still coming in strong. And 70% of our economy is a service economy. So, the PMI numbers are down for manufacturing, but service numbers still strong. We saw a strong jobs number from ADP this morning. I think some companies are beginning to hire ahead of the summer rush. They remember what they went through last year when they couldn't find summer employees. So I think some companies are hiring ahead of that. As far as housing seems to be a huge topic. Everyone's waiting for home prices to come down. Look, home prices went up 30, 40%. If they pull back 10%, 15%, it's not the end of the world. It's not like 2008. It's a correction, but not something deathly. I came up with my theory called Game of Homes. Yes, it's a play on Game of Thrones, the TV show, but it's the dozen reasons why home prices should be supported. Home prices have continued their uptrend and kept aloft by lack of supply. Slow build out. Again, labor's expensive, construction's expensive, slow build out. Still strong post-pandemic residual demand. Price inflation. Demand for millennials forming households, and there are more millennials than boomers. Remodeling projects. Remember all those people remodeling their homes during the pandemic, redoing the kitchens, adding porches, adding swimming pools. Well, all that added value to homes and made the prices go up. Then there are a lot of people escaping their high tax states like California and New York, going to Florida, Arizona, or Texas. Some of those people sold their homes, but a lot of people kept their home in their old state so they could use it as a second home and moved to a new state and bought a home. So you had people buying homes but not selling their old homes. Again, constricting supply. On top of that, next reason, a lot of individuals as well as large funds were purchasing home supply as an investment to lease out and therefore sucking up supply. You also have the mortgage interest rate differentials that make it harder for people to sell or trade out of their starter home to a larger home, therefore crimping supply of smaller starter homes for new buyers. And quite frankly, the last reason why I think home prices will be supported is people are getting used to the higher level of prices and just beginning to psychologically accept that as the normal price. So we've covered the outlook, we've covered debt ceiling mayhem, commercial real estate, my recession radar, game of homes. Let's look forward. What are the opportunities? I see opportunities in private investments. That's an area I love, spend a lot of my time on. I tend to look for investments that can do well in a normal economy, but really take advantage of some economic turmoil or dislocation and possibly do better when there is a dislocation. So private credit is one of those areas. Distressed, opportunistic debt that can lend to companies in need when there's a dislocation, maybe sink their teeth in with heavy, heavy covenants. I believe there'll be a lot of opportunities in real estate, especially in real estate debt. Marty mentioned venture capital and lending. I still like venture capital. Actually, I love venture capital. It's part of my MIT background, I suppose. I think it's an exciting growth area for the country. I'm still dripping the idea of venture capital to my clients, but we've held back quite a bit because I think a lot of venture capital is still overpriced. But if you have a new fund that can look for valuations to come down before making their investments, I think there's a lot of opportunity there. My one caveat to all of this is that there is a lot of private money foaming at the mouth on the sidelines, waiting to hop on bargains. And some of them may jump in a little early and not allow prices to slide as much as you and I would like them to slide. So that really covers my topics. I'm happy to do some Q&A. Marty, can you help me out with that?
I've got a lot of questions. Any questions here in the audience? I got a lot of questions. Okay, great. So I guess that a lot of people were saying that there's problems with the economy, but then I think there was an article, maybe it was in the Wall Street Journal or somebody said it on TV that, corporations are still doing well. They're pass on price increases to customers and they seem to be getting by. So any thoughts on that and how it applies to a recession?
I agree. Earnings have come down. We're maybe seeing a little bit of an earnings recession because earnings have retreated. But we're not yet in the territory where companies are in trouble. I think though there's room, some areas, construction, some of the weaker companies, we will see an uptick in defaults. But again, I think there's a lot of money ready on the sidelines to swoop in and help out companies that fall into default or take them over.
I'm kind of struggling here between real estate and venture capital. Let me just jump into venture capital.
Marty, I lost volume. I don't hear you. Sorry, Marty, I'm not hearing anything. I'm getting like a whisper. Try again, Marty.
Now.
Yeah. Okay.
Okay, great. So Silicon Valley made repercussions on venture capital. The short and sweet is they were giving prime +1 loans to ventures. So we were at Cincinnati in Austin, and the guy said to me, he says, well, you know, if you've got a $10 million raise from like Series A, you can get a $3 million loan from Silicon Valley Bank was kind of implicit. But the venture lenders are lending at prime plus 12 or 13, right? And then the venture lenders I speak to say they're not going to be increasing their volume. So does that make you change your thoughts about venture capital? And then my follow-up question is, a lot of people think, you know, family offices should be investing in venture, but, you know, there was kind of a decline in equities, in public equities portfolios. So, and there hasn't been that mark-to-market in the venture capital. So any thoughts on that in terms of like,
So you're cutting out. Can you hear me okay?
Right.
Okay, so you're cutting out. I think I heard most of the question. Look, a lot of venture firms are going to be in trouble. Silicon Valley Bank was a terrific lender and a terrific friend to to startups. So was First Republic, quite frankly. And between the loss of two of them, it is a major hit to venture capital. I think, though, there were maybe too many startups. I mean, I remember 8-9 years ago, there were probably 800 venture capital firms. And then a few years ago, venture capital funds. Then a few years ago, that number was about 3,000, 4,000 VC funds. And right now, we're north of 7,000 VC funds, incubators, accelerators. Possibly we have way too many funds. And each of those funds is trying to fund a startup. And hey, economically, that sounds like a great idea to be an engine of growth. But I think there's probably way too many startups. They can't all be good and they can't all make it. It's almost too much competition. So a little bit of weeding out might help the market. Even so, I think if you have a smart VC fund helping you out, doing the selection, they can find the good opportunities. And especially, look, in the past, I'd love to see a fund that was 80% invested. And then I could see the investments they did. Usually they had markups. And I'd be like, that's great. I'll be the last money in. I have a terrific backwards look. But that has flipped. Right now, if I see a fund that's 80% invested, I'm just automatically going to assume that they overpaid for a lot of those investments, unless they can prove to me otherwise. I'd much rather see a fund that's a blind pool, which is a little bit unusual. Usually you don't like to see a blind pool. But right now, I want a blind pool in private credit and real estate and venture capital that can take advantage of dislocations and cheaper prices. So yes, I still like venture capital, even with the turmoil going on, if you have a good manager. And I think we've all seen the statistics that the disparity of returns in venture capital is greater than in private equity or in private credit or in real estate. There's really a huge disparity of returns between the top quartile and the bottom quartile. So if you can find a group that's more likely to be in the top quartile or have people help you, I have people help us find those managers that are more likely to be in the top quartile, I think you're more likely to find success.
Question, Gary?
Oh, yeah, I had a question here.
Yep.
Hi, Gary.
Can you hear me okay?
Yes.
Okay, am I the only person in the audience that's short, both a customer and also short First Republic Bank? I shorted it in part because I needed a hedge against my deposits, first of all. But no, I have a more important question, and that is that this is what I could not find. What are the default provisions on U.S. Treasury bills and securities? Is there a default interest rate? Is there a make whole? I know the reason why the interest rates are so high is because if you default on a treasury bill, it has to be marked down by the money market funds to zero, and that breaks the buck on the money funds. But do you have any comment on that? Because that's really the biggest question of the day here.
So two comments on that. One, I don't think it has to be marked down to zero. it just has to be marked down to the price that they could sell it at. So if you have something at par, call it 100, and it just went past maturity but didn't pay off, someone like me might buy it, but I'd say, hey, I'll pay you 95 cents on it and assume that I'll get that extra 5 cents. I just don't know when I'll get it. Will I get it in a week, 2 weeks, 2 months? So the real question mark is on the timing to the payoff. So you'll have plenty of people willing to buy the paper at a discount, and if I can get, 5% return within a week, that's huge. Annualize that, that's like a 250% return. So there will be a bid there. But as far as the default provisions, I did a quick look and I didn't find any, but I didn't do a deep dive. So my best answer is I don't know, but I'm just going to assume that the interest payments stop. So you won't get, I'm just assuming you won't get interest on the excess days. So if it takes 2 more weeks, you won't get 2 more weeks of interest. So, what you really want to do is just buy it at a discount.
Okay, I'm going to ask Mark again because I looked at it and I couldn't find anything in the published literature. So we'll ask him again because obviously there's a lot of people here because of, say, a 5% interest on 1 or 2 or 3 month securities. And if you're in California, you don't pay a California tax. It's anywhere from 9 to 14%. So it's actually equivalent to a 5.5 or higher interest rate. Okay, well, thanks.
Welcome, and I'm with you. We started talking to our clients back in February of last year, telling them to take their cash out and move it into T-bills. And it's not because we saw a huge banking crisis, but we did see our clients' cash accounts and their business cash accounts just sitting on a lot of cash, earning 0.1%. And you're right, in California, New York, they're paying state taxes on that 0.1%. And we could, over time, get them 2, 3, 4, 5% on their T-bills and without state tax. So bonus, and more, and technically more secure because their FDIC accounts were only insured up to 250,000. But yeah, we started doing that over a year ago. Just, overall, it seemed like a smart move, even though we weren't predicting a bank crisis.
Okay, well, thanks for your thoughts. That's great.
Real quick, so you had mentioned the potential headwinds of the U.S. Dollar becoming less of a currency. What are the opportunities offshore, given the fact that you would have the opportunity?
Marty, I can't hear. I heard the beginning and then.
So is the question U.S. dollar resiliency?
Well, no, the question is, given the fact that the U.S. dollar might be
De-dollarization and investing offshore.
Say that again, Marty.
De-dollarization?
Yeah.
And investing offshore. Should we be investing dollars offshore?
A little bit. I've spent a lot of time in Asia and Europe. And, when you talk to Asian investors or European investors, usually they talk about diversifying currencies. It's one of their early investment conversations, like maybe 20% dollar, 30% Europe, and then various Asian currencies. But they're, all about diversifying the currency. And for many years, that has really worked against them because the dollar's held pretty strong. A lot of those other currencies really haven't. So for the last 10, 20 years, it's not always worked that well. But nonetheless, long-term trend, I think the pool of money, the pie is growing. The US currency is just going to be a smaller slice of that pie. Maybe it moves from, 67% of global reserve currencies down to 63% of global reserve currencies, maybe 59% of global reserve currencies. But the pie of total global reserve currencies is growing. So the dollar demand is going to continue to be there. Nonetheless, it doesn't hurt to diversify into some foreign investments. We always want that diversification. And you especially want to do it when the dollar is strong, because then you can buy more of the European assets or more of the Asian assets or more of the African assets. So yeah, nothing against it. We have had, I'll admit, a domestic bias in our investment portfolios, or I have for the past dozen years. For the most part, that's worked well for us. But tides change, and
Oh, I see.
we're looking to diversify a bit more.
There, I guess you were on, you were talking to me.
Oh,
Matt,
no problem.
Matt, thank you. Question on venture capital. Why do you assume a fund that's 80% funded is not a fund that you would enter into? And why do you believe that they overpaid for their assets in the fund? Why? So the question is, why do you believe a fund that's 80% funded is not funded? And why do you think that they've overpaid for assets?
Yeah, so like I said, that's my bias when I just walk into a deal. I'm just stereotyping. And, I do that with investments. And like I said initially, unless they can prove to me otherwise, I'm just going to assume immediately that they overpaid for them. And that's because in 2020, most of 2020 and 2021, valuations were high. Companies were being valued at the seed level at 15 million and above. Or pre-seed at 15 and seed level at 30, and then Series A at 60. And I just saw too many high valuations, especially when they didn't have a minimum valuable product, or still just in the idea stage. So I just thought a lot of valuations were out of whack. And
yeah,
sure, there's some good investments were made, and that's what I said. If they can prove to me otherwise, fine. But I'm just going to walk into a meeting or a conversation and assume they overpaid in 21 and and even part of 22, the first half of 22, until valuations started coming down.
Yeah.
And we've seen a correction in late stage. We've seen a huge correction, maybe 40%. But early stage, we're at the beginning of seeing a correction. Personally, as an investor, my money and my clients' money, and I treat my clients' money as my money, from an investment standpoint and philosophy, I'd like to see the valuations come down more. On a multiple, if a seed is valued at 12 million versus 4 million, that's a huge difference on multiple. I'd much rather get in at the 4 million and have, better potential for a 7, 8, or 9x return than get in at the 12 million and be gunning for a 3x or 4x return.
Yeah, Michael, I think there's going to be a lot of LPs and GPs crammed down in the next couple of years. Yeah.
Yes, I think so. And from some of the late stage companies, I think you're going to see some flat rounds. I think you're going to see some of the larger names supporting the companies they're invested in, maybe not wanting to do a cram down or down round, but they'll just do a flat round. So the company may have grown 60%, but they were overvalued 2 years ago. And so even though they've seen 60, 80% growth, they'll just be valued at the same level.
Any thoughts on the crash in new media stocks? I mean, or companies, I guess, is it BuzzFeed that just shut down, and you're seeing a lot of other companies that are suffering a lot? Any thoughts on that, or any comments?
Not too much, not too deep. I mean, funny enough, Reuters asked me and quoted me regarding BuzzFeed and HuffPost, and I think they are going to their core competencies and trying to offer something unique, because there's just so much media out there. It's so competitive, and the advertising dollars have pulled back a bit.
I agree. I mean, there's a whole question of bots out there and everything else. So I got to return to real estate. And so on the one hand, there's too much office. On the other hand, there's a real housing shortage, right? But my understanding is that converting offices to housing is really difficult, to multifamily, because of windows and things like that. So, any thoughts on that, on the CRE solution? I mean, obviously, and through the magic of the internet, I've got something from a company called Pace Equity, which I'm gonna hold it up here. There's 37 states which are doing PACE loans these days. Matt Kessler's going to speak about that later. Can any thoughts on PACE loans as a substitute for banks pulling back on lending? Thoughts like that. So I mean, as I said, there's a disparity. Like when we overbuilt malls, it was kind of easy to turn those into multi-purpose real estate, right? Because all you got to do is just gut out one side of the mall and you put up apartments there, and then you're in pretty good shape, right? You've got a multi-purpose real estate. But any thoughts from your point of view?
So the malls, in some respects, you're absolutely right, were easy to convert once you got the permission to convert them. So a lot of malls, the stumbling block was you needed the permits from the city to convert it into something different. Or if you had huge anchor tenants, where their contract said there was going to be this much retail or this much stores, or you had the little stores that were promised anchor tenants and then the anchor tenants disappeared, you had to get consensus from them that you could convert it into something that was multi-use. Maybe there's some stores, some gyms, nail salons, hair salons, restaurants, and apartments, and offices, or warehouse space. So you needed the permits and permissions, and that was part of the stumbling block. But you're right, as far as physically converting them, malls relatively easy to convert. As I mentioned earlier, if you have small footprint office spaces, there's enough windows and light to get to the center of the building, so you don't have dark living spaces. So those are relatively easier to convert to apartments or condos. But if you have a large footprint office space, you're going to have a huge dark area in the middle.
So some more thoughts, we went through this huge real estate pullback in 2008, and it kind of lasted for 3 or 4 years. I always say the turning point of real estate was when we ran an event at the Beverly Hilton, and I had 4 single-family real estate funds that said, we're buying up everything we can. And so at that point, when we had the event, I think it was like February of 2011 or 12, and we had so Phoenix, Arizona had a backlog of 15 months of housing supply. And then 2 months later, it was down to 1 month. Like everybody, all these funds came in and bought, Phoenix. So, I think the real estate turnaround had what I'm going to call some deus ex machinas, right? I mean, we pulled back on scrutiny of where money was coming from. So you saw like all these Russian oligarchs were buying apartments in New York and Miami. Chinese EB5 money built Brickell Avenue in Miami, right? I mean, so you got the EB5 money coming in from China. A lot of these external, forces in real estate. Do you see anything like that happening again, or because I mean, we were in the doldrums for a really long time, for 4 years in real estate, in decline, and since the bubble's even bigger now, your thoughts?
Marty, I think you bring up a terrific point, and a brilliant thought on that. Doing it with houses and individual condos is a little bit easier than doing it with whole office buildings. In this case, because you can have the EV buyers, the individual buyers, taking individual, properties in whole. A little bit harder with offices. Nonetheless, I think there's a lot of money on the sidelines waiting for this, waiting for the bargains, trying to plan out either mezzanine loans, rescue loans, or just take over. I talked to an investor last night that's looking to do that in Mexico with property along the ocean. And he has it all planned out. He needs to probably come up with 65, 70 million for that initial bite, put another 20, 30 million into it, but then, it should all be money good. So you just need bigger bite sizes, but I think there's a lot of cash on the sidelines, smart money looking for bargains. And yeah, that will soak it up. So like I said, I think the real butterfly effect is you'll see a pullback in bank lending on a lot of this stuff. So maybe, smart money comes in with some equity and they get a private lender to help back them. Maybe they get a bank loan on it. Or maybe they just put in all equity because the returns are so good at this point, they don't need to leverage.
And Michael, are you in Newport Beach or you're somewhere in Orange, right, these days?
I love Newport Beach and I still have a home there, but I'm living in Manhattan Beach. Our office is in El Segundo, which is right below the Los Angeles airport.
So, I mean, a lot of comments from the audience on Los Angeles in the future. I mean, are we like in a Snake Plissken sort of era of Los Angeles, or things, or is
what era?
John James era of Los Angeles? Escape from Los Angeles, the movie?
I may have missed it. I may have missed that movie.
Snake Plissken, Escape from New York?
Escape from LA.
Gotcha.
Okay, so what are your thoughts on LA and Southern California?
Everyone tells me that people are leaving California and LA, and a lot of us wish that was true because then traffic would go down. But we're not seeing it. We're not seeing it in the traffic. We're not seeing it in the housing and apartment demand. You know, if people are leaving, I don't know
Kurt Russell.
where they're going because yeah, the demand here for housing, for real estate is strong. There still seems to be demand even for offices if it's very hip, modern, contemporary offices, 1 or 2 story buildings where you can walk in, have a courtyard, park right next to it. There's huge demand for that kind of office building versus the huge towers, because people don't really want to go to work in a tower and park in a parking structure. But if they can park in a parking lot and walk into a nice 1 or 2 story building that's open space, modern, light, has a courtyard, has a nice kitchen area, people want that. So there's demand even, you know, for office space here. It's just what kind of office space.
So we'll talk more about that, although I'm running into people from LA and Nevada, Idaho, Texas,